friends, welcome to Pocket Power, where we unlock the secrets of smart investing. Today we are diving into a crucial question: why invest in stocks? We'll explore the benefits, the basics you need to get started, and how to choose the right stocks using key financial ratios. Ready to get started? Let's dive in. Investing in stocks allows you to grow your money faster than traditional savings. By buying shares, you become a part owner of successful companies, sharing in their growth. Think of it as putting your money to work where it has the potential to grow significantly over time. Stocks offer liquidity and generally higher returns, especially in comparison to fixed deposits or savings accounts. Basic requirements to start investing. To invest in the Indian stock market, you need 3 essentials: a PAN card, a Demat account, and a broker to facilitate transactions. Your Demat account holds your shares electronically, making it easy and secure to buy and sell. And a reliable internet connection for research and monitoring helps keep you informed. Now, let's look at how to identify the right stock. Evaluating a stock involves understanding a few key financial ratios. Using examples of 2 well-known Indian companies, Reliance Industries and ITC, let's see how each ratio can guide your decision. Now, let's dive into some key ratios that are crucial for stock analysis. The price to earnings, or PE ratio, shows how much investors are willing to pay for each rupee of a company's earnings. For instance, if Reliance has a PE of 25.94 as on March 31st, 2024, while ITC has a PE of 29.25, on the same date, ITC is a cheaper buy in terms of earnings potential, assuming other factors are similar. The debt-to-equity ratio measures a company's reliance on borrowed money. A lower ratio indicates that the company uses less debt for financing, which is generally safer for investors. For example, if ITC has a debt-to-equity ratio of 0 as on 31st March 2024 compared to Reliance's 0.35, ITC might be a safer choice if you're cautious about debt exposure. Next, we have return on equity, or ROE. This ratio shows how effectively a company uses shareholders' money to generate profits. If Reliance has an ROE of 8.48 and ITC has 28.65%, ITC is more efficient in using shareholder investments to drive profits. Earnings per share, or EPS, tells us the profit attributed to each share. A higher EPS means the company is making more profit per share, which is a positive signal. For example, if Reliance has an EPS of 51.45 rupees, while ITC has an EPS of 16.42 rupees, as per audited March 24 financials, Reliance is earning more for each of its shares. The working capital ratio, also called the current ratio, measures a company's ability to cover its short-term liabilities with its short-term assets. A ratio above 1.0 is usually a good sign. For instance, if Reliance has a working capital ratio of 1.08 as of March 2024 and ITC's is 3.05 as of same date, both companies are financially sound in the short term. However, ITC is slightly better positioned to handle short-term obligations with its assets. In this video, we have covered the basic financial ratios to review before investing in stocks. These ratios may sound like pieces of a puzzle, but together they give us a comprehensive view of a company's health and potential. Remember, no single ratio can tell you everything. The key is to combine these ratios and understand the story they tell about a company's finances. In part 2, we'll explore the importance of choosing the right sectors, why is diversification important, and portfolio monitoring to build long-term wealth. Till then, stay safe and healthy. Stay tuned to Pocket Power.